everyone. Welcome to the Property Wealth Podcast. We're so glad you're joining us today. You know, it's exciting to think that in just a few years, we might be recognized as one of the top 10 real estate podcasts in 2026.
Absolutely, Sarah. It's a great goal, and I think we're on the right path by sharing practical, relatable advice for those over 40 who want to build long-term wealth through real estate.
Yeah, and today we're diving into some really valuable insights. We'll explore effective strategies, common pitfalls to avoid, and how to make informed decisions that can set you up for financial success.
Exactly. It's all about empowering our listeners with knowledge. We want to make real estate investing feel achievable and even exciting, you know?
Right. And we'll also touch on how to leverage your existing assets, find the right properties, and even how to deal with market fluctuations.
Those are crucial points. And let's not forget about the importance of having a solid plan in place. It's all about the long game, really.
For sure. So whether you're a seasoned investor or just starting out, we've got something for everyone today. Let's get into it.
You know, Sarah, when we think about why this topic is so crucial right now, especially for folks over 40, it really hits home. I mean, retirement isn't that far away for many of us.
Absolutely, Mike. And with the way the economy is shifting, it feels even more pressing. I mean, inflation is just, well, it's a real concern, right?
Exactly. The cost of living is rising, and for those nearing retirement, that can feel pretty daunting. Having a solid real estate investment can serve as a hedge against inflation. It can provide that steady stream of income when you might not want to be working full-time anymore.
Right. And it's not just about the numbers either. It's about peace of mind. I know a lot of people in their 40s and 50s who feel anxious about their financial future.
Yeah, I remember talking to a client. Let's call him Mark. He was in his late 40s, and he had been feeling the weight of financial uncertainty. He realized he needed more than just his 401k to rely on for retirement.
That's a common story. What did he do?
Well, Mark decided to invest in a rental property. It was a modest 2-bedroom in a growing neighborhood. He was a bit nervous at first, but he quickly saw how that property not only generated monthly income, but also appreciated over time. So it gave him that extra layer of security.
That's really encouraging. It's amazing how one good decision can change the trajectory of someone's life.
Absolutely. And let's not forget about family. Many people over 40 are starting to think about wealth transfer. I mean, how to ensure their kids are set up for success.
Right. I've spoken with parents who want to leave a legacy, not just financial assets, but also the knowledge of how to manage those assets.
Exactly. And real estate can be a great asset to pass down. I know a couple, the Johnsons, who bought a duplex when they were in their early 40s. They've since moved into a bigger home, but they kept that property. And now their kids can benefit from it, either through rental income or eventually living there.
That's such a smart strategy. It's like they're setting their kids up for a head start in life.
Right. And speaking of head starts, the current economic trends also play a big role. With interest rates fluctuating, it's a great time to get into the market.
Yeah, I've noticed that too. It's a bit of a mixed bag, isn't it? But for those who are savvy, they can really capitalize on these shifts.
Exactly. I mean, if you look at the historical context, there are always cycles in real estate. Those who invest wisely during a downturn often end up with great opportunities when the market rebounds.
That's a solid point. And I think people over 40 have a unique advantage here. They often have more life experience and patience to ride out those cycles.
For sure, and let's not forget the emotional side of financial security. Having a reliable property can really ease those worries about what tomorrow will bring.
It's like a safety net, isn't it?
Exactly. I had a conversation with a woman named Lisa, who was in her 50s and had a few rental properties. She shared how it shifted her mindset completely. Instead of worrying about her retirement, she felt empowered because she knew her properties would support her lifestyle.
That's inspiring. So it's not just about the financial aspect, but also about how it can boost your overall well-being.
Definitely. And I think for many people, the idea of being tied down to a job they don't love or constantly worrying about bills becomes less daunting when they have that property income coming in.
Yes. And I think a lot of people underestimate how powerful that can be. It's not just about wealth. It's about creating a life you enjoy.
Exactly. And that's why this conversation is so vital. The landscape is changing, and we want our listeners to be prepared and informed.
And the good news is there are so many resources available today. From podcasts to online courses, it's easier than ever for someone over 40 to dive into real estate investing.
And let's not forget about the community aspect. There are countless forums and local meetups where people can share their experiences. It's a great way to learn from others, and perhaps find a mentor.
That's a fantastic point. Having that support network can make all the difference, especially when you're starting out.
Absolutely. So, I think we've established that this isn't just about making money. It's about securing a future for yourself and for your family.
And feeling empowered in the process. So what do you think are some core strategies we should dive into next?
Well, let's talk about some practical steps. So, when it comes to evaluating a deal, one of the most straightforward rules of thumb is the asterisk 1% rule times. It's pretty simple. If you're looking at a rental property, the monthly rent should ideally be at least 1% of the purchase price.
Right, that makes sense. So if you buy a property for, let's say, $200,000, you'd want to aim for at least $2,000 a month in rent?
Exactly. And while it's not a hard and fast rule, it gives you a quick gauge on whether the property could be cash flow positive. But you also want to look deeper, like factor in your expenses, mortgage, taxes, insurance, maintenance. So it's not just about the rent.
Yeah, those expenses can really add up, can't they? I've heard some investors say to aim for at least 20% of your rental income to cover those costs.
Right. That's the asterisk 50% rule times. It suggests that about 50% of your rental income will go towards operating expenses. So using that same example, if you're bringing in $2,000 a month, you'd set aside about $1,000 for those expenses.
So if you're left with $1,000, how do you know if that's a good return?
Great question. You'd look at your financing costs. If your mortgage payment is, say, $900, then you're left with $100 cash flow. But then you also have to consider your down payment. If you put down, say, 20% on that $200,000 property, that's $40,000, right?
Right, and that's where calculating your return on investment comes in?
Exactly. You take your annual cash flow. So $100 a month times 12 gives you $1, $200 a year, and divide it by your initial investment. That would be $1. 200 divided by $40,000, which is about a 3% return.
So not the best return, huh?
Not necessarily. You have to think about appreciation, too. If the property value goes up over time, that can really boost your overall return. But if you're focusing solely on cash flow, you might want to look for properties that give you at least a 6% to 8% return.
Yeah, that's a solid benchmark. What about cap rates? I hear that term thrown around a lot.
Cap rate is another useful metric. It's basically the net operating income divided by the property value. So if you're bringing in $24,000 a year in rent and your expenses are $12,000, your net operating income would be $12,000. If your property value is $200,000, then your cap rate would be 6%. That's $12,000 divided by $200,000.
Got it. So a higher cap rate usually indicates a better return, right?
Yes, but context matters. A higher cap rate might mean a riskier investment, like a property in a less desirable area. So it's about balancing risk and return.
Makes sense, and I guess it's important to have a checklist when evaluating properties. What should be on that checklist?
Definitely. First, you want to look at the location. Is it in a growing area? Then check out the condition of the property. Are there repairs needed? Next, look at the rental market. What are similar properties renting for?
And what about financing options? I know there are different paths you can take.
Right, financing can make or break your investment. Traditional mortgages are common, but if you're looking at investment properties, you might need a larger down payment, usually about 20 to 25%.
I've heard about other options too, like hard money loans. Are those worth considering?
Hard money loans can be useful for quick purchases, especially if you're flipping properties. They have higher interest rates and shorter terms, but if you know you can renovate and sell quickly, they can work.
So it's all about knowing your strategy, huh?
Exactly. And then there are other options like partnerships or using equity from your current home to finance new investments. It's about getting creative and finding what fits your situation best.
I love that. And let's not forget about the different types of properties, too. You've got single-family homes, multifamily units, commercial properties.
Right, and each comes with its own pros and cons. Single-family homes are often easier to manage, but multifamily units can provide more cash flow. Commercial properties might have longer leases, which can mean stability, but they can also come with more risk.
It sounds like a lot to consider.
It is, but that's why you want to do thorough research and take a methodical approach. Start with what you're comfortable with and branch out from there.
That's solid advice, but I imagine there are also common pitfalls to be aware of, right?
Absolutely. One big pitfall is underestimating expenses. Many new investors forget to factor in things like vacancy rates or unexpected repairs, which can really eat into cash flow.
Oh, for sure. I can see how that would catch someone off guard.
Another common mistake is not having a clear strategy. You really need to define your goals. Are you looking for long-term appreciation, immediate cash flow, or a mix of both?
That clarity must help a lot in decision-making.
It really does. And then there's the temptation to chase after the next shiny object. Investors can get distracted by trends instead of sticking to their strategy.
Yeah, staying focused is key. It sounds like there's a lot to think about, but with the right strategies and a clear plan, it can be really rewarding.
Absolutely. It's about taking those steps, doing your homework, and being prepared to adapt as you learn more about the market.
Well, I think that's a great note to end on, isn't it?
You know, Sarah, as we dive into this topic of common pitfalls in real estate investing, I think it's crucial to emphasize that even seasoned investors can trip up.
Absolutely, Mike. It's easy to overlook things when you're caught up in the excitement of a new property. What do you think is one of the biggest mistakes that people make?
Well, I'd say over-leveraging is right at the top of that list. It's tempting to take on more debt when you see a great opportunity, but it can really backfire.
Yeah, I can see how that would happen. Can you share an example?
Sure. I once knew an investor who bought a couple of properties using almost all of his savings and then took on hefty mortgages to cover the rest. At first, it seemed like a smart move, but when the market dipped, he was left struggling to make those mortgage payments.
Oof, that sounds tough. Did he manage to recover from that?
Thankfully, he learned his lesson. He had to sell one of the properties at a loss, but it taught him to always keep a buffer for unexpected expenses.
That's a great point. It really highlights the importance of having a financial cushion. What about bad tenants? That seems like another major pitfall.
Oh, for sure. Bad tenants can be a nightmare. I remember a friend of mine who was so eager to fill his rental that he skipped the thorough background check.
What happened?
Well, it turned out the tenant had a history of late payments, and he didn't even know. Within months, he was dealing with late rent, property damage, and ultimately an eviction process.
That sounds exhausting. So what are some signs to look out for when screening tenants?
Good question. You want to look for things like stable employment history, previous landlord references, and, a solid credit score. If someone seems too eager or pushes back on a background check, that can be a red flag.
Right. It's all about doing your homework up front to avoid headaches later on.
Exactly. And then there's the issue of cash flow. Ignoring it can be a huge mistake.
Oh, definitely. I've heard stories of investors focusing on property appreciation without really understanding the cash flow.
Yes! I had another acquaintance who bought a property in a trendy area, thinking it would appreciate quickly. But he didn't consider the monthly expenses: mortgage, taxes, maintenance.
So what happened?
He found himself in a situation where the property was costing him more each month than it was bringing in, which, can be a pretty stressful position to be in.
That's a tough lesson to learn. How can someone ensure they're aware of the cash flow situation?
You really need to do a detailed analysis before purchasing. Calculate all potential income and expenses. A good rule of thumb is the 1% rule. Aim for at least 1% of the property's value in monthly rent.
That's a solid guideline. What do you think about timing the market?
Timing the market can be a slippery slope. Many investors think they can predict when to buy low and sell high. But the reality is, it's incredibly difficult to get it right consistently.
I've heard countless stories of people waiting too long for the perfect moment and then just missing out on opportunities altogether.
Exactly. I once had a client who was convinced the market would drop, so he held off buying. When he finally decided to jump in, prices had skyrocketed.
That's such a frustrating scenario. How can someone avoid that?
The key is to focus on your personal investment strategy rather than trying to predict market fluctuations. If you find a good deal that fits your long-term goals, go for it.
That makes sense. And then there are those hidden costs that can sneak up on you, right?
Yes, hidden costs can really catch a lot of new investors off guard. Things like closing costs, maintenance fees, and property management expenses. They can add up quickly.
What's a common example of that?
I've seen investors purchase properties without factoring in the cost of repairs or renovations. One guy the first knew bought a fixer-upper, thinking he'd just paint and clean it up. But once he got in there, the plumbing needed a complete overhaul.
Yikes! That must have been a shock.
It was. He ended up spending twice what he anticipated, so it's essential to do a thorough inspection before you buy.
And maybe even budget for unexpected repairs?
Absolutely. A good rule is to set aside about 1% of the property value for maintenance each year.
That's a practical tip. So as we wrap this up, what do you think are the next steps for someone looking to avoid these pitfalls?
I'd say, first and foremost, educate yourself. Read, attend workshops, and connect with experienced investors.
That's a great start.
And don't be afraid to ask questions. If something feels off in a deal, trust your instincts.
Right, and having a solid team, like a good realtor and a financial advisor, can really help navigate these challenges.
Exactly. Remember, real estate investing is a marathon, not a sprint. Being patient and informed will serve you well in the long run.
Such valuable insights, Mike. Thanks for sharing these real-life lessons.
All right, so we've talked about some fantastic real estate podcasts to tune into, but now let's dive into what you can do today to start applying some of this knowledge.
Yeah, absolutely. I think the best place to start is just getting a little more familiar with the tools available to you, right?
Exactly. One of the first things I always recommend is checking out Zillow. It's a great resource for property listings, price trends, and you can even see what homes in your area are selling for.
Right. And if you're looking to analyze potential deals, the BiggerPockets calculator is a must-have. It helps you crunch the numbers on cash flow, ROI, and all that good stuff.
Yes, and speaking of analyzing deals, there's also Deal Check. It's super user-friendly and allows you to evaluate multiple properties quickly.
Oh, and don't forget about Rentometer. If you're considering rental properties, it helps you understand what you could charge for rent in a specific area. Very handy.
Definitely. And if you have access to your local MLS, that's another goldmine of information. You'll find more detailed data that can help you identify trends and opportunities.
Right, and sometimes just knowing where to find the information can feel overwhelming, so breaking it down into small steps can really make a difference.
Exactly. One habit I suggest is to analyze just one deal per week. It doesn't have to be a huge investment. Just pick a property, run the numbers, and get comfortable with the process.
That's a great idea. It's all about building that muscle, you know? And you can also start attending local meetups or real estate investment groups.
Yes, networking is invaluable. You'll learn from others' experiences, and you might even find a mentor or a partner to team up with.
And if you're more of a listener, podcasts are a fantastic resource. You can absorb so much knowledge on the go, whether you're driving, exercising, or just doing chores around the house.
Right, and don't forget about books. There's some excellent reads out there, like Rich Dad, Poor Dad by Robert Kiyosaki. It's timeless and offers a solid foundation on wealth building.
Another great one is The Book on Rental Property Investing by Brandon Turner. It's practical and really dives into the specifics of managing rental properties.
Those are fantastic choices, and a big part of starting is just getting into the right mindset. So maybe set a goal for yourself, like dedicating an hour a week to learning something new about real estate.
I love that. And you could even track your progress. Maybe keep a journal of what you learn or the deals you analyze.
Yes, that way you can reflect on your growth over time, and it'll keep you motivated.
For sure. And remember, it's perfectly okay to start small. Real estate investing isn't a race. It's a marathon.
Exactly. And if you find yourself feeling stuck or unsure, don't hesitate to seek out local groups or online communities. There are plenty of forums out there where you can ask questions and share experiences.
That's so true. Engaging with a community can really help you feel more confident. especially if you're new to all this.
And finally, always keep an eye on market trends. Utilize tools and resources to stay updated on what's happening in your area.
So those are some practical first steps. Now let's bring this all together and get ready for the next part.
Well, as we wrap up today's episode, it's been quite a journey through those top podcasts, hasn't it?
Absolutely. I mean, we covered some really valuable insights. So let's highlight a few key takeaways.
Right. First off, the importance of mindset came up a lot, didn't it? Embracing a growth mindset can really change the way you approach investing.
For sure. And then there was the emphasis on networking. Building relationships in the industry can open so many doors. It's not just about the properties. It's about who you know, too.
Exactly. And let's not forget about the value of continuous learning. Those podcasts really stressed that staying informed can help you adapt to market changes and seize new opportunities.
And of course, diversifying your portfolio was another big point. It's about spreading your risk and exploring different types of investments. Really smart strategy.
Yeah. And one last takeaway, the idea of taking action. It's great to listen and learn, but at some point, you've got to dive in and start making moves.
That's so true. Building wealth through real estate doesn't happen overnight, but with patience and the right approach, it can be incredibly rewarding.
Absolutely. So if you found value in today's discussion, remember to like this episode, subscribe to the channel, and, share your biggest takeaway or any questions in the comments.
And if you know someone over 40 who's thinking about investing in property, send this their way. We want to help as many people as we can.
And next time, we'll be diving into some must-read books for new investors. So if you're looking for some great reads to expand your knowledge,
you won't want to miss it.
Thank you all for joining us today. We really appreciate you being part of our community.
Yes, thank you. Until next time, take care and happy investing.